Ladies and gentlemen, good day and welcome to Thomas Cook India Limited Q4 FY22 and FY22 earnings conference call hosted by IIFL Securities Limited. As a reminder, all participants' line will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand over the call to Mr. Akul Broachwala from IIFL Securities. Thank you, and over to you.
Thank you, Hemant. Ladies and gentlemen, good afternoon, and thank you for joining us on the 4Q FY22 earnings conference call of Thomas Cook India Limited. I invite the company's senior management team who are here to discuss the results and business strategy. We begin the call with opening remarks by Mr. Ashish Nandi, President and Group CFO, followed by the management team, and thereafter we'll open the call for a Q&A session. I would now like to hand over the call to Mr. Nandi to take proceedings forward. Thank you, and over to you, sir.
Thank you, Akul. Good afternoon, ladies and gentlemen. This is Ashish Nandi. I would like to start off by introducing the participants from Thomas Cook as well as from Sterling, Thomas Cook, SOTC and Sterling. So we have Madhavan Menon, Managing Director, Thomas Cook India Limited. We have Mahesh Iyer, CEO and Executive Director, Thomas Cook India Limited. Vishal Suri, MD of SOTC. I also have Brijesh Modi, CFO of Thomas Cook. I have from Sterling, I have Mr. Vikram Lalwani, who is the MD of Sterling, as well as Krishna Kumar, who is the CFO. I also have Urvashi, who runs the investor program out of investor relations program in Thomas Cook, and Abraham Elabat, who runs our our marketing services. So let me start off. I'll start off and then I'll hand over to Mahesh. So let me start off with the overview of the results. As we have seen, our income from operations for the quarter has moved up from 357 crores to 522 crores, which is a jump of about 46% on a quarter-on-quarter basis as compared to last year. Our operating EBITDA has moved at a consolidated level, has moved into the positive territory. We had a loss of 36.1 crore last year, same quarter, and the operating EBITDA now moved to 23.9 crores. While this is operating EBITDA, we had to make some adjustments for certain mark-to-market losses, gains and losses to arrive at the EBITDA, and let me take a minute to explain this. We have an employees trust which has some quest shares earmarked only for distribution to the employees, and these are yet lying undistributed in the trust. And therefore, since they are still lying in the trust, we need to make at the end of every quarter, we need to make an assessment of the mark-to-market gains and losses. As we have seen, the share prices of Quest, like in many other companies, has been very volatile during this period, and that causes changes in our EBITDA. The operating EBITDA gets influenced by that. I'll just give you a simple example to explain that. For quarter 4 last year, FY21, the mark-to-market gains from Quest shares was 20.5 crores, and that boosted or rather reduced the losses that we made. Our operating EBITDA, as I mentioned, was 36.1 crore losses. The reported losses were 15.6, and that was primarily due to the gains we made out of Quest. This year, unfortunately, the position is reversed. While we made operating EBITDA gain of 23.9 crores, the Quest mark-to-market losses were 24.7 crores, and therefore, at the EBITDA level, we are more or less, break even. Moving over to the consolidated results. Our income from operations for the full year went up from 795 crores to 1888 crores. That's an increase of over 38%. Our operating EBITDA losses have reduced very sharply by about 54% from last year. 275.7 crores was the figure last year, and this year it went down to 127.3. The Quest mark-to-market gains again played a role here. Last year, we made a gain of 67 crores on Quest mark-to-market gains. And this year we have actually incurred a loss of about 4 crores for the full year. So that has brought down. So our current year EBITDA looks depressed, because of that fact. What is the important thing that is to be noted is for this quarter is that this is a quarter when 3 of our companies, there are many companies in the group, as you know, 3 of the companies in the group became profitable. These 3 companies are Thomas Cook India Limited, SOTC, and our company in East Africa called Private Safari East Africa. These became profitable after a gap of about 7 quarters. Some other companies in the group continue to do well. Desert Adventures, our unit in Middle East, and DEI, which is also headquartered in Dubai, delivered profitable quarter for the 2nd successive quarter. And Sterling continued its profitable run for the 6th successive quarter. During this quarter, we also managed to strengthen our balance sheet substantially. We have, as you know, we had issued optionally convertible redeemable preference shares amounting to about 436 crores last year. During the last quarter, we have converted 302 crores out of that into equity shares, which resulted in the promoters' shareholding going up from 65.6% to about 70.58%. The balance 133 crores is going to be converted in the April-June quarter as well, which will push up Fairfax's holding by about another 1.7%. The cash on the balance sheet at the end of March was 640 crores, which showed a robust position as far as availability of cash is concerned. The overall debt position, and here I'll break it up into long and short term. Our overall debt position was about 454 crores, of which about 128 crores was long term. That included 72 crores under the export credit scheme, ECLG scheme, as it's known popularly, which comes at a lower interest rate, and the short term or the bank overdraft and the working capital demand loans were about 327 crores. All of these reflected in the CRISIL rating. CRISIL rating, we continue to enjoy a CRISIL rating of A+ right through the year, reflecting the stability of the balance sheet and their continued faith, CRISIL's continued faith in the company's operations. I will now hand over to Mahesh, who will take you through the company's results and talk about the prospects. Thank you.
Thank you, Debashish. Good afternoon, everyone. This is Mahesh Iyer. I am the Executive Director and CEO at Thomas Cook India Limited. Since Debashish has already walked you all through the numbers, I thought it's important to highlight some of our key achievements that led to this kind of a positive performance in the current quarter. To begin with, I'll kind of give a quick summary on the businesses of Thomas Cook and SOTC, which is more on the travel and travel-related services, and then also walk you through some of the other subsidiaries which are overseas in terms of DMS, DEI, the companies that Debashish spoke about, and then hand over to Vikram, who will walk you through the sterling numbers. To begin with, at SOTC and Thomas Cook, the dominant business at Thomas Cook being foreign exchange, continued to do well, and as we have said in the past too, the business at Thomas Cook for foreign exchange was very least impacted by the pandemic to that extent, because we qualified under essential services as early as June of 2020, and we were able to offer services to customers, be it on the remittance side or be it encashment. And that business continued to remain profitable just after the 3 months of the forced lockdown that happened between April and June of 2020. Every other month from July 2020 right till March 2022, the business continued to be EBITDA positive and continues to be so at this point in time also. From a recovery point of view, the foreign exchange business had recovery in the various lines within its business in different varying percentages. The retail business at this point in time for first quarter recovered close to about 68%. From a corporate recovery point of view, we are roughly around 35%. And the airport businesses, which again is a barometer of how the inflow of traffic is coming, is currently operating at about 26% recovery. Now, if I kind of give a flavor to how we are looking at this trending into Q1 of FY23, and I'm making a forward-looking statement which is already qualified, we are actually seeing our trends to be even more positive as compared to what we saw in the quarter ended of March. Our retail business currently is trending closer to 70% of the pre-pandemic level. Corporate volumes have actually substantially improved. We are trending at close to about 57%, and the airport has already moved up to close to 43%. So from a recovery point of view, ending March quarter as well as looking into June, our expectation is that this recovery is going to be very, very strong, buoyed by the fact that the borders have opened up. International commercial flights resumed operations from 27th of March, and with the opening up of offices for corporates and they were getting back into businesses, the sentiment in terms of recovery is very, very positive. Also important to highlight here that when I'm talking about the retail recovery, this retail recovery on the foreign exchange is led by the remittance business and a very small recovery as far as the travel-related business is concerned. As you would know, as I mentioned, 27th March is when the borders have opened up, international commercial flights have started operating, hence the travel bookings have just started to come in, and the holiday part of the retail foreign exchange business is still to take off. So my expectation is that as that business gets into some amount of momentum, the retail volume should very quickly catch up in terms of getting to past the pre-pandemic levels, well ahead of our targeted number of December 2022. Moving on to the other piece of the foreign exchange portfolio, which is the borderless prepaid card. The prepaid card that we operate in the business is currently operating at about 80% of the pre-pandemic level, buoyed by the fact that both retail as well as corporate segments have kind of flown in terms of transactions. Most of it is being the ITES segments where large contracts have been won and in a form to where employees are attriting. Corporates find it very easy to kind of place them on onshore contracts where they are locked in for a longer period in time, and that's kind of helping our volumes to come. Also, the sweet spot on this business is the float that we generate, and for the quarter in question, we generated about $10 million of float on our borderless prepaid card. That adds to our cash balances also. Coming over to the holidays business, here I think that's a bit of a mixed bag in terms of Q1 or rather Q4 of FY22 and my projection for Q1 FY23. As far as Q4 of FY22 is concerned, the domestic business is trending very close to the 2019 numbers, and there have been months where we actually surpassed. Now, again, we must be mindful of the fact that we are talking about a quarter which was a truncated one because we had the Omicron effect. So for about 45 days, a large part of our operations came to a standstill. But despite that, I think the domestic business witnessed a sharp comeback, and as we speak today, we are already trending much ahead of what we did in 2019. Now, if I kind of look at from the international holiday perspective, there are two parts to it, the short haul and the long hauls. The short haul are more the destinations which are closer home, the Far East and the Middle East. Over there, our recovery in terms of volumes compared to 2019 is close to about 45%, whereas it's the long haul, typically the Europe, the US and Australia, where there are challenges both from connectivity point of view and also visa restrictions, as you will appreciate that there are no visa slots available. They have truncated their people, and the processing time is anywhere between 6 to 8 weeks for most of the geographies. And in some long-haul destinations like US, your next appointment is not before December of 22. So given those external challenges, I think the recoveries are a little slower. But for Q1, we've already witnessed close to about 20% recovery to the 2019 numbers. But our expectation for Q1 of FY23 is that we should be trending closer to about 40%. So we are expecting a 2x kind of a growth that would come in over the next 45 days. And the forward pipeline for us is looking very strong as far as the holidays business is concerned. It's also important to highlight here that there are external challenges, headwinds in terms of inflated airfares, and also to the fact that because of the crisis in the Russia-Ukraine sector, airfares have kind of remained heightened and is likely to remain so. This kind of puts pressure on the cost, on the input cost, while this is passed on to the customers. Obviously, decision making from a customer's point of view gets a little delayed. Our expectation in the current year is the cycle is likely to be a little longer. Typically, we look at an April, June, or maybe a July quarter as far as the holiday season is concerned. This year, our expectation is that the holiday season will run right into September and will quickly be followed by the Puja holidays and Diwali, which is the festivities. So we are looking at a year-long holiday season this year as compared to the pre-pandemic, where we would actually qualify April to July as the peak period for the holiday season. Coming back to the next part of the business, which is corporate travel, I think again that's one business which has kind of outshined on a lot of counts. One, the number of active corporates that we have has actually moved up by about 50% month on month. So a lot of corporates have come back into offices and started to travel. And this entire format of saying digitally operating has kind of gone through the wind. People are expecting to meet customers for their sales and as far as their new business is concerned. So clearly that momentum has started to come in. While a lot of this volumes and transaction counts that we are seeing is on the domestic side, internationally has started to pick up. As I mentioned before, 27th March being the cutoff date when travel actually started in. We have started to see a good momentum coming in there, and our expectation for Q1 of FY23 is that we should be very close to the pre-pandemic level by the close of Q1 FY2023. Also important to mention here, from a mix point of view, other than the domestic and international, which is around 89% domestic to about 11% international, the air to non-air ratio has also substantially changed for us. Now, it's a sweet spot for us because that's high yield, high margin business, specifically bookings like hotel, car rentals and stuff like that, or other ancillary services that we do for our corporate customers. Clearly over there, we have seen some uptick there. So we have moved our range from about 7% penetration to about 12%, and our expectation for the full year that we should be closer to about 15% in terms of air to non-air ratio. And that should help in terms of improving our yields on those businesses also. The last part of the business is the meetings, incentives, conferences and exhibition. On that side of the business, it's been a bit of a slow start. We saw some smart recovery coming in the December quarter, but obviously the March quarter got impacted as a result of the Omicron. A lot of the travel that used to happen in the December quarter was domestic, and the domestic travel got impacted because of the Omicron. But clearly the forward pipeline that we see on the business is very, very strong. Also important and noteworthy to mention here is that we've got some large contracts, especially from the government side, and the government business on the MICE side is looking very, very promising. At this point in time, the recovery on the business is about 30%, and for our expectation for Q1 of FY2023 is it's likely to be about close to 50%. So overall, if I look at a company level, our expectation for Q1 FY23 is likely to be about 55 to 60% of the pre-pandemic level. And we see that momentum building up both in terms of our forward booking pipeline as well as our conversations with the customer. It's also important to mention here that there are supply side constraints both in terms of input costs as well as availability, but those are the headwinds that we have to face. But clearly we are an aggregator of services, so whatever is the input cost we are passing it on to the customer, and that's going to be reflected in our yields as they are today also. Moving over to a quick summary on the other entities that we have within the group. To begin with, the DMS entities, and I think Debashish spoke about it briefly in his introductory comment. Desert Adventures and Private Safari East Africa, the two entities, both of them turned positive. In fact, Desert Adventures was positive in the December quarter also. They had some sharp volumes coming from Russia in the previous quarter, continued to trickle in the current quarter also, and had some groups coming from Latin America. So clearly that volumes continue to flow into their businesses. Apart from that, they also had the benefit of cost savings that they had bought in, which has flown into their P&L, and they continue to remain positive. As you would appreciate, the period between April to June happens to be a low season because summers get very hot there. So clearly we expect some amount of slowdown to happen, but for the full year, they were positive last year, and we expect that for the current year also, they should be EBITDA positive in the current year also. Private Safari, for the first time in the current quarter, turned positive, albeit a very small number that came in, but again, it shows the confidence of people coming back and traveling again, and I think that should carry well through the rest of the year. The forward booking pipeline again for that business is looking very strong, and our expectation is that these two businesses should continue to remain profitable for the rest of the year. There are two other units within the DMS, which is Asian Trades, which operates largely out of the Far East Asia or Southeast Asia. They are a bit slow to start with. The markets have just opened up, specifically Vietnam, Thailand have just about opened up. They have started to get in bookings, and our expectation is that over the next 2 quarters, we should be starting to see some volumes adding up into their bookings. Last but not the least, our business out of US, LIP Pro, again has started to see some strong bookings flowing in. The FIT business specifically, the mix of the business has actually changed, where they were focused on GIT. Now they are more FIT focused. We've seen some large volumes flowing through, and our current forward bookings on that business is trending very close to 2019. So our expectation for the full year is that they should turn profitable or at least be at a break-even level, and we expect some good outcome to come. The DEI, the photography and imaging business, that's the other business that we operate, which is slightly different from the travel business that we operate in, continued to remain profitable second quarter in a row. On the December quarter, they were profitable, and in the March quarter also, they had EBITDA positive. This is largely because of the recovery in some of the markets that have happened, specifically Dubai, which is kind of led the pack. We are about close to 90-95% of the pre-pandemic level as far as the entire Middle East market is concerned. If I look at markets like Singapore, Hong Kong, which are Malaysia, which are the other markets that have just about opened up, they are already trending at about close to 50-55% of the pre-pandemic levels. Again, they have taken some measures in terms of cost optimization, which is beginning to play in, and our expectation for the full year is that they should continue to remain profitable, and we should be able to deliver cash on the table for us. Last but not the least, before I hand over to Vikram, I'd like to spend a minute on some of the technology initiatives that we have taken. The last 18 odd months, we spent a lot of time in terms of technology transformation, where the focus has been to improve the touch points or reduce the number of touch points that the customer has in dealing with the company, at the same time improve the overall experience that he gets dealing with us, whether it is the foreign exchange business, whether it is the holiday business, or whether it is the B2B business of MICE or corporate travel. Also, we've taken a lot of, or put in a lot of technology in terms of robotic process automation and AI to improve our conversions and also automate a lot of processes, so that when the market opens up to the full extent, the savings that we have baked in during the pandemic continues to flow into our P&L. I'd like to reiterate here that we made a statement that we will make in about 40% of our cost savings that have been baked in, will continue to hold on for the rest of the year also. On that note, I'd like to hand over to Vikram for his opening comments and take it on them. Over to you, Vikram.
Yeah, good afternoon. My name is Vikram Lalwani, and I represent Sterling Holiday Resorts as its Managing Director and CEO. I'm joined by Mr. L. Krishna Kumar. He's our Chief Financial Officer at Sterling Holiday Resorts. Ladies and gentlemen, it's a privilege to interact with all of you this afternoon. We are delighted to announce that Sterling has been profitable for the financial year 21-22, despite losing 5 months of business during the financial year due to the pandemic. In effect, we had 12 months of cost and only 7 months of revenue. And despite that, we are happy to announce that we have been profitable for the entire financial year. We have had 5 straight quarters of positive PBT, and this reflects and reaffirms the strategy that we had adopted post-pandemic. In this approach, we have scaled up our non-member business at our resort, thus impacting room revenue. We increased spend in terms of average rate at our resort, and food and beverage spend at our resort as well. We focused on cash generation through our membership business. For the year, our resort occupancies increased by 9 percentage points. Average rates improved by 19%. We increased our food and beverage spend by 20%. We improved our average unit rate by 8% on membership sales, and a shift towards a variable model of membership business at a resort, thus driving an operating EBITDA growth of 48% and an operating free cash flow of 25% for the year. In FY22, despite the pandemic that affected us in Jan and part of Feb, our operational EBITDA has been positive, driven by a higher average rate and spend at the resort. During the year, we launched 3 new destinations: Alleppey, Gir in Gujarat, and Thiruvannamalai in Tamil Nadu. With this, our portfolio has grown to 36 resorts as on close of 31st March 2022. The total number of keys that now we have in our portfolio is 2,300.
Sorry to interrupt. This is the operator. I would request you to check your audio line. It's not clear. There's some kind of a static problem.
Am I audible now? Is it?
Yes, you're audible, but there's a kind of a static problem in there. So kindly check the line.
All right. So while we check the line, I'll carry on. So we have a total of 2,300 keys in our portfolio. We continue to build a pipeline of resorts in all new destinations and shall light them up incrementally to increase our portfolio of resorts in popular leisure destinations in India. Our expansion strategy was initiated even pre-COVID, and that shall continue even going forward, in which our focus of expansion is on an asset-light method to increase our portfolio of resorts. From a customer perspective, 97% of our resorts are ranked 4 and above on 5 in TripAdvisor, with 60% of our resorts ranked in top 5 in their respective destinations as on close of March 2022. During the year, we had taken several initiatives at Sterling to introduce new customer products. We adopted digital practices to transform our business methods and enhance our distribution capabilities without adding incremental fixed costs in order to increase our revenues, and this is can be sustained as we go along. My team and I at Sterling are extremely upbeat and buoyant in our outlook for Q1 FY23, given the pipeline of business that we have in our book for Q1, as well as for the remaining part of the financial year.
This is the operator. You're able to hear us?
Yes. Yes, we're able to hear.
Yes, you can continue. The line is clear now.
Yeah, we are done. We are finished from Sterling side.
Okay, thank you.
Hemant, you can open the line for questions, please.
No, just the final piece from Mahesh. Okay, fine. Right.
You can go ahead with the question.
Thank you. We will now begin with the question and answer session. Anyone who wishes to ask a question, anyone who wishes to ask a question may press star and 1 on your telephone keypad. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question comes from the line of Ankit Kanodia with Smart Sync Services. Please go ahead.
Thank you for taking my question, and good to see you back after 2 years in the Concall. We met you. So, first of all, the question is regarding if you can give us a brief understanding about Sterling Resort in terms of when we acquired the company, what was our thought process, how things have gone in the past few years, and how do we look at Sterling strategically in the next few years? If you can give some color as to what worked, what didn't work, and how do we plan to prepare ourselves ahead, that would be great.
Can you hear me?
Yeah.
Okay. Immediately after acquisition, when we are actually expanding our portfolio of resorts, we went into a lease mode of operations in terms of acquiring resorts, and some of the resorts during that period also went into gave us the good market share and also gave us good profit in some of the resorts. But
can't understand. Maybe there is some
because of the fact that some of the leases were not making enough money. But when we started to streamline our operations in the beginning of the year 1920, That's when the pandemic struck us in the year March of 2020. And pandemic really affected our operations in the financial year 2021 and in the year 21-22. While 2021, the effect was much more sharper and deeper. 21-22, we were able to manage slightly more better. What happened during pandemic was that we were able to actually look at our operations with slightly more microscopic view of the cost and other infrastructure. We were able to cut down our cost substantially. The cost came down on the payroll front first, and some of the other areas of administrative and other IT-related expenses. Now, with costs being brought down substantially in the last 2 years, and after the pandemic, which is April, May of 2021, when the business started coming back, we also noticed that the pattern of travel has completely changed. People have started traveling because we missed 2 summers. April, May, June is a substantial quarter for us, because that's when most of the business happens in this industry. But unfortunately, the last 2 financial years, the first quarter, April, May, June, has been completely a washout. But having said that, in July of last year, when the resorts started opening up and business started coming in, we noticed that the travel patterns have changed and people have started traveling all over the year actually, and therefore that is the starting point. And from July to December, the business was started to go up. But again, Omicron came in the month of Jan-Feb. We saw a dullness in those 2 months, and then from March it picked up. Now, what has happened in the last 2 to 3 years? Yes, we gave up some of the loss-making locations. We went into more profitable locations. We also expanded our portfolio by going into a managed contract kind of resort, where our exposure in terms of capex and opex is much less. And therefore, we are able to, with all these combinations, we are able to get into a very profitable year for this financial year, FY21-22. Also, the membership part, what we've done is we have cut our exposure across all the branches in the country. We have gone into acquisition into more profitable locations. And where do the profits come from? If we sell more from the resort, on-site sales we call it, I think you make more money. So in the membership business also, we have scaled down operations across all the branches. We have moved into more profitable locations. We are able to attack customers with new products and services directly at the resort location itself, and thereby improve the membership EBITDA also in the financial year. Having said that, with both the membership business and the resort business profitability is going up, and with cash coming in, we are able to maintain a healthy cash balances, and the debt levels at the banks also have come down. So that's the status of the market too. The future, April, May of the current year, the first quarter looks very, very promising. I think you have noticed that most of the weekends our occupancies are gone up to almost 98-99%. And we are expecting this quarter to be one of the greatest quarters in the last 4 years. That's the update I would probably say.
I'll also step in here, where our strategy has been very clear in terms of ramping up our revenue. So we actually also built a non-member vertical at Concall Resort, wherein we attract business segments such as FIT, conferences, weddings, just like typical any other hotel or resort. And today that component of the overall occupancy is about 60%. So we've been able to ramp up the non-member business at our resort. We've been able to drive efficiencies, better efficiencies in our membership business. We will continue the hybrid model of non-members and members, and we will optimize that depending on the time of the year. Also, a big shift that we had embarked upon, in fact, this was in the pre-COVID level, was to expand in an asset-light model. And since then, we have over 12 resorts where we actually expanded in the asset-light model. In an asset-light model, we have no capex. We are using our distribution strength. We use our sales and marketing verticals, as well as our operations verticals across our resorts. We run the resorts for the owners and we manage it, and we get monetized on the basis of that. So this is completely zero capex model of expansion, and we embarked upon that pre-COVID, and even during COVID we continue to expand using that model. Even as we speak today, the pipeline is pretty strong for new destinations and new resorts for us to expand in them. So that's how we are structured, and that's how we have obtained profitability, and now we are looking at scaling it up to the next level.
Yeah. Thank you so much for the detailed answer. That really helps, sir. And my next question would be related to DG Photo Entertainment Imaging. So this is one of the business which we have acquired recently, and if I'm not wrong, probably this is the fastest growing business in terms of revenues. So if you can throw some color as to what is the business model, who are our clients, and how do we see it going forward, that would really help us understand it much better.
Sure. Ankit, hi, this is Mahesh, and I will take that question. So, as you rightly said, yeah, it's a new kid off the block. We acquired this in somewhere in 2018 and 2019 beginning. That's how the business came into our fold. Just to give you a color to the kind of model they operate, they are into the what I call the imaging solutioning services company. It's kind of adjacent to a travel service company because most of the sites that they operate in are the sites where a traveler will typically go when he's in a country or a destination where he's traveling to, attractions as we call it in the travel parlance. Now, effectively what they do in those businesses, they have got cameras, cameramen or automated cameras which capture photography at different times when you're celebrating or having a good experience, and that's being sold for a value to the consumer. Now, from a market penetration point of view, they have about close to 250 plus sites in which they operate. They have operations spread across some 11 countries, and their annual run rate in terms of revenue is top of about $85 million. So that's the kind of volume that we are talking about. Clearly, from a business model point of view, it's more tech-driven. It's a technology services where we believe a lot of opportunity to kind of coexist and co-sell with travel and travel-related products exists there. So while that's not a core focus that we are focusing on a standalone basis, the business is very profitable with very little in terms of co-opting or co-selling with other companies are concerned, but on their own, they have a very strong footprint across the globe. I must also mention here, they are the second largest imaging company in the world, and also some of the new contracts that they have got in specifically in China, which is their first market that they've got in post-pandemic. That seems to be opening very well because these are some of the large sites we are talking about, which is Universal Beijing and Disney Hong Kong. So Disney Shanghai. So clearly we see a great potential. The business model is well entrenched. It's led by technology. There is some amount of people intensiveness there, but I think the pandemic has kind of given us the opportunity to kind of right size, infuse a lot of technology, upgrade some of the technologies, which kind of allows us to kind of go in and bid for new contracts and make that business profitable going forward. I must also mention the business doesn't require cash. It's not a capital intensive business because the capital cycle on that or the working capital cycle is less than 30 days. So it kind of funds for itself.
Thank you so much. That really helped. My last question would be related to the cash position we have in the books right now and how, during the start of the pandemic, in Feb 2020, we earlier wanted to do a buyback when there was a big fall in the market. But later on, we changed our stance and we stopped that, and rightly so, because there were requirements of funds at that point of time and there was a lot of uncertainty. And now when that uncertainty is no more there, and assuming that the COVID is past us, if the market again gives that kind of an opportunity, say if our stock price goes down, would we be willing to do that buyback again because of the cash we have on the books, or do we have any other plan?
Yeah. Hi Ankit, good afternoon. Madhav and Menon here. Look, when we went into the buyback, obviously you clearly articulated the rationale behind why we went into it. obviously things changed, and we worked with SEBI to get this buyback cancelled. The reality is, as on today, given what we've faced over the last 3 years, I think our first priority is to bring the business back to normal, functioning normally, get all our businesses firing on full cylinders rather than looking at a buyback at this point of time. Having said that, no opportunities are off the table, Ankit. At some future date, if we do see an opportunity and we believe that we can get there, we will, we will consider it, but it's definitely not on the table today.
Sure, sir. Thank you so much. That's it from my side. I'll come back in the queue if I have any more questions.
Thank you. The next question comes from the line of Nidhi Babaria with Dalal and Broacha. Please go ahead.
Hi, sir. Thank you for taking my question. Sir, just a couple of questions on Forex side. This full year, our Forex losses have increased significantly on a YoY basis. Like last year, we were making profits, now we are making losses. What type of year do you see like FY23 and 24? And my second question would be what like the competition from Revolt and other players are coming intensely. What would be our stake on these new age companies, and how are we going to compete these companies?
Nidhi, I'll take both those questions. Mahesh here. Point number one, with regards to profitability in 2021 versus loss in 2022, I think they are not comparable. And you appreciate that the year that we are talking about, FY22, also had a profitable quarter, which is the Jan-March quarter. So that was a full operating month because pandemic hit us somewhere in the last week of March 2020. So to that extent, there is a profitability element that sits in there. As compared to what we are seeing in the current quarter, we had a large or a long runway in terms of losses, which was the pandemic hit period. Also to mention that from a recovery point of view, as you can see in the current quarter, which is the last quarter of FY22, you would actually witness that into the foreign exchange, the segmental numbers are actually talking about the improvement in performance from about 27 crores that we had in Q4 FY21 to Q4 FY2022. We have moved to about 38 crores. So clearly, from a recovery point of view, the business is back. And as I mentioned in my comments in the opening remarks also, the business continued to remain profitable, albeit we are still doing a catch-up game because we are not at the pre-pandemic levels. The borders have just about opened, and the travel-related foreign exchange side of the retail business is still to come back to normalcy. What we are witnessing today in the foreign exchange business is large part of remittances, which are student and other related remittances that we are doing, and they are already trending at higher than the pre-pandemic levels. But a large part of our portfolio, close to about 50% of our portfolio, also on the travel side of foreign exchange, which is still at a very nascent stage in terms of recovery, and is directly linked to the international holiday travel that will take place. So the season has just begun, and our expectation is that somewhere before the end of this year, we should be close to about full recovery to the pre-pandemic levels. Coming to the second part of the question in terms of competition from the players that you mentioned. Well, look, the space that we play in is very different from what the competition plays. We are not a technology or a digital company only. We are a brick and mortar which also offers technology, seamlessness and ease and convenience to do a transaction. I think our key success factor or the USP that I would call about is our ability to seamlessly execute the transaction across all channels without creating a friction for the customer. Now, at the end of the day, the price is very transparent. As in the past, price wasn't so transparent, but today everyone knows the price of the dollar in the marketplace. So the price is no more a game that anyone plays. It's more about how the experience is. And I think, given our past and our experience of this business, kind of puts us in good stead to kind of take any competition that comes in place. I would also like to mention here, as I spoke about the digital transformation that we did across our businesses, in the foreign exchange business also, we have digitized a lot of our processes. And one process which is very specific to digital change that's happening in this is the KYC process. You will appreciate that this is a regulated business and a lot of documentation needs to be collected and stored on record. We've kind of automated that entire process at the back end here, and a customer can transact through a video mode with us without having to step out of his office or home, and we will deliver the foreign exchange at his doorstep, all in under 2 hours. So clearly, we've kind of taken the process back where it matters to the consumer and reduce the amount of handshakes that we do in a transaction, and that we believe will kind of define the success in futures to come.
Okay. Thank you, sir.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star 1 on your telephone keypad. Thank you. Now, the next question comes from the line of Senthil Manikandan with iThought Financials. Please go ahead.
Hi, thanks for the opportunity. My first question is on the DMS side. So, is it given overview of the performance during the year, and also how do you see going forward?
Okay, this is Debashish here, and I'll take that question. So Mahesh has covered that in the course of his overview, but let me get into a little more specifics on the DMS side. So the DMS, some of the DMS units have, returned to profitability fairly early, and it depended really on what was the restrictions regarding visa and the access to tourists. So, for example, if we look at, we have five units across Asia Pacific and Asia Pacific, Africa, and the US. So, if I look at the Asian units, in Middle East, we have a unit called Desert Adventures based out of Dubai, and they operate also out of Oman and Jordan. So they returned to profitability fairly early in the October-December quarter. In fact, as we mentioned, this is the second quarter in which they are continuing to be profitable, and it is also the only unit in the Thomas Cook Group which was profitable for the full calendar year of 21. As you know, tourists have been coming into Dubai in a fairly unrestricted manner during the last 7-8 months, and they have taken advantage of that. The inflows of tourists is largely from Eastern Europe, Russia, Eastern Europe, as well as the western part of Europe, and they get some amount of customers from South Africa and US as well. So that is continuing, and they will, and some amount of tourist inflows also happened because of the expo that happened, that was there between October and March. In terms of prospects, I think we'll see a lower inflow in the next 3 months because that's the peak of the Dubai summer. But post that, we can see a fairly large amount of order booking. So we are very sure that we'll continue to do well and will continue to remain profitable. The next unit in line in DMS that I'd like to talk about is the one in Africa, East Africa. That's a unit based in Kenya, which does business in Kenya as well as Tanzania. Now, they have the peak season for them is actually start from end of June, the migration season, and it goes on till about end of August or early September. But even in the off-peak season of Jan-March, they turn around very smartly. In fact, they did something very innovative. They introduced charter safaris. So in the world of safaris, typically we see small groups coming in, but they were the first in Kenya to introduce charter flights for safaris, and they got in passengers from Eastern Europe, like countries like Romania, etc. And that led to a fairly large inflow of customers. Their order bookings are very comparable to the numbers they had in 2019, and we are quite sure that they are for the full year they will show somewhere they will be very close to 100% recovery as compared to 1920. The third unit in South Africa, which is a smaller unit, it is South Africa went through several rounds of the COVID-19, including the Omicron, as you know, but they have recovered from that, and now the order bookings have started picking up, and we are again quite sure that, like Kenya, they will also show a sharp turnaround in the coming quarters. In USA, the LIC Pro unit that we have is doing very well in terms of order booking. The summer season starts in June in US, but if you look at, all you can talk about is order bookings. In terms of order bookings, they're at about 95% of the level they had achieved in 2019 at the same time. And we are very sure that as time progresses, they will catch up and they will probably go to closer to 100% recovery. The last but not least of the units is Asian Trails, which operates in Southeast Asia. Now, this is one in which has been affected the most because, as you know, the restrictions on visa and tourist access were lifted very late. In fact, it's only recently that it's been lifted in Vietnam and Thailand, which are major markets for them. So they have started receiving order bookings, and their season it's actually quite in time because the principal season starts from about July. That's the time when Europeans go on holidays, and we cater primarily to the European tourists. So we are looking forward to a decent summer, and we'll see a decent recovery in the July-September quarter.
Great, sir. Thanks for the detailed answer. Second question is on the cash flow generation. So as you mentioned that pre-COVID versus now you're operating at a 40% cost reduction level. So over the next 2 to 3 years at the consolidated level, what would be the sustainable cash flow generation?
So, pre-COVID, we are generating, as a group, we are generating about 200 crores of cash a year. Obviously, with the onset of COVID, all that got wiped out. But, that cash flow that we generated actually helped us to stay afloat and revive during these 2 years. Going forward, I'm sure, like Mahesh mentioned, we'll get back to normal capacity and grow beyond that in FY24 and beyond. And we'll be back to ways of generating cash like the way we did. So we can, right now we are obviously not generating cash. We are just about, we are at a break-even level as far as slightly better than a break-even level as far as EBITDA is concerned. But we will start generating cash fairly soon as our business goes beyond a critical mark. I think the one important point here, Senthil, is that we have managed to bring down our break-even point very, very substantially because of the massive cost reduction that we have undertaken. At a consolidated level, our costs are about, at a standalone level, at India level, the costs are down by about 50%. At the overall level, the costs are down by about 45%. And I'm talking about operating costs. And this is as compared to the pre-pandemic levels. We expect that we'll be able to hold on to most of these cost savings. And that is what is bringing down our break-even point, which is why even with a sales which is far lower than what it was in the pre-pandemic times, we have been able to reach the position that we have done.
Great, sir. Thanks for the clarification.
Thank you. The next question comes from the line of Mithun Ashwath with Kiva Advisors. Please go ahead.
Just wanted to understand more on the profitability side. How do we gauge in terms of what sort of sustainable margins could we do in each of the segmented businesses if we reach pre-pandemic levels of revenues? Because there are some businesses which have reached that level, but your travel business still continues to be quite lower, much lower than pre-pandemic level. So just wanted thoughts on that. Now, if I go back to FY19 full year profits, the margins on an overall basis were not great even in FY19 or FY20. But with these cost reductions, if we were to reach those levels maybe in 23 or 24, maybe more like 24, what sort of margins at an overall level could the company potentially enjoy? Because I think in the last quarter, we were at, operating break even on a consolidated level. Just wanted your thoughts on that, because as you grow, will expenses also come back to some extent is what I wanted to understand.
Okay. Devashish here, Mithun, and let me try and take that question. So, Mithun, there are two parts to this. Okay, one part is obviously the gross margin, and one is the EBITDA, the net margin. In terms of gross margin, I think we haven't lost ground. Okay, we have continued to operate on the same or even better gross margin than what we did previously. Foreign exchange is a case in point. Domestic is a case in point. Foreign exchange used to run at between 1.2 to 1.3% gross margin. We are running around close to about 1.4% right now. And that 10 bps is a lot as far as Forex is concerned, given the nature of the business. Domestic business is running at domestic where we are actually, as of now, we have crossed the pre-COVID levels. We have moved up the margin from 15 to about 17%. So that's just some examples of the margin improvement. And even in the areas where we haven't reached the pre-COVID levels, even then we have held on to the margin. That's something very dear to us. And we know that in order to get back to profitability, we need to hold on to those gross margin levels. But there's a layer of fixed cost below that, obviously, which takes us to the EBIT level. Now, in terms of the fixed cost, this is where we have achieved a sharp cost reduction. So if we look at, let me quote some numbers compared to FY20, FY22 vis-a-vis FY20. So if I take a full consolidated view, our overall staff cost for FY20 was 830 crores. And this is down to, for the full year, this is down to 498 crores. And incidentally, for FY22, in FY22, starting 1st of April, we had restored all salaries. So this is not with any salary cuts, etc. So at full salary, our costs are down by about 40%. In respect of establishment and utility costs, etc., our costs went down from 548 crores in FY20 to about 257 crores in the current year, or in the year that just went by, which is a reduction of 53%. Overall, our costs went down from 1378 crores to 755 crores. That's a reduction of 623 crores, which is about 45%. Now, you're quite right. Some of these costs will come back. For example, we will get incremental marketing costs, marketing and promotional costs. However, those tend to be variable because we can regulate that spend based on the sales that we are getting. So we're not really bothered. If we get more sales, we spend more on marketing, and therefore there's no negative impact on the bottom line. As for the other costs are concerned, the staff costs are there to stay because our headcount is frozen as of now. We are not encouraging any new hiring. In fact, we are operating at a lower than a budgeted headcount. And in the past 2 years, we have actually focused a lot on technology in order to make sure that we don't need to increase headcount when the business comes back. Mahesh covered this extensively during his speech, and that would help us to keep the staff costs down. And if the staff costs are down, then most of the other costs are connected to headcount. And so those, as we have seen, those costs will also be kept down. Does that answer your question?
Yeah, I just wanted to get a sense. See, obviously, we've not really had even one normal quarter in the last maybe 6 or 7 quarters. Maybe the December quarter was reasonably okay. I'm just trying to sense from the, your own, forward bookings and all that. Where are we in terms of how close we are in the travel business to pre-pandemic levels, or how long do we have to go to reach those revenues that you used to do? Just want to get a sense on that, because then the profitability at an overall level would change quite materially, and we would get a better picture of what is your run rate, which could be sustainable. So just wanted thoughts on that.
Mr. I will take that question. This is Mahesh here, and this is also available on the investors presentation that we uploaded. If you look at the business-wise recovery percentages that we've spoken about there, if you look at the last quarter that went by, different businesses at different stages of recovery. On an average, I will put it at a company level, we are close to about 45 to 50% in Q4 FY 2022. But if you look at the optimism in terms of what we are projecting based on the bookings that we have on hand and the conversations that we are having with customers, clearly it's moving up by at least 50% or 50% as compared to Q4 of FY22 just in one quarter. So the momentum and the pace at which the recovery is happening is very, very fast, and there are multiple reasons for it. One, it's for the first time after March 27 that we've actually seen commercial flights actually taking off. And there are still supply side constraints. The full schedules have not been filed. The airlines are not operating to full capacity, and there are capacity constraints there. So is the case with hotels and hospitality. If you look at them, they're also not operating at full capacity. A lot of them have gone out of business. So is the case with restaurants. A lot of them who went out of business. Now, as the COVID wanes out and people are getting back into business, the capacity is getting added up. So clearly, from our point of view, as we see, we are seeing the recovery happening very quickly, and our expectation on different businesses getting back to the pre-pandemic level are at different stages. As I mentioned initially, the foreign exchange business, we expect that to come to near 2019 levels before the end of this calendar year. I'm not even talking the financial year FY23, I'm saying calendar CY2022. If I look at the corporate travel business, our expectation is somewhere by Q2 of FY23, that is Q3 of CY22, we should be closer to the near pandemic levels. The two other businesses, which is the B2B side of the holidays and the B2C side of the holidays, and more importantly focused on the international side, is where the recovery leg is going to be a little more longer. And the reasons for that is one, borders are still opening up. You would have read the news around New Zealand only opening up from 31st of July. Thailand has just opened up. Vietnam has opened up. US, while it's opened up, there are visa-related challenges. So there are multiple, I would say, blocks that we need to still fix into this entire puzzle before the market recovers to normalcy. Our expectation on the holiday side, we should be seeing a full recovery to 2019 levels somewhere around the second or third quarter of FY24, not before that. So that's our kind of estimation in terms of the holiday business. But I think the other businesses which will turn out the volumes and the yields, as Debashish rightly said, we are holding on to the yields and in many cases improved our yields. And with the cost saving measures that we have put in place, the texture and the flavor of our profitability should start looking much better.
Vikram here. Can I also step in for resort?
Please, Vikram.
Yeah, okay. So as far as the hospitality and resort business is concerned, the outlook, what we're seeing in Q1, I think what we've seen in April and May so far, has far exceeded what we had done in April and May of 2019. Because for 2 years we were shut during this period due to COVID. And in the resort business, months of April, May, June is actually the strongest month in the entire financial year. Given that, it's a summer season and people do travel during summer and it's holiday time. In terms of even sustainability, even if we have to compare with what was there in 2019 and what is there today, we have ramped up our distribution channels without adding any fixed costs. So that's how our turnover and revenues are growing without an incremental growth in fixed costs, number one. Number two, we had several of high cost, low profit lease resorts in 2019, same period, that we've also replaced with more profitable, better destinations, asset-light resorts. So to that extent, even as the business scales up in Q1 and going forward, it need not add on the same kind of costs that added on in the comparable period of 2019. And why am I looking at 2019? Is because of the fact that was the peak of COVID levels, and that was the time when we had our entire inventories operational. So that's what I wanted to emphasize from a resort side.
Got it. Just one last question on your cash balance, which you've shown in your presentation of over 600 crores. How much would that be of free cash balances in terms of you would have some advances and other numbers also in that? Just wanted to understand, because your interest cost on a quarterly basis is close to 17 crores. And the last one is also on your depreciation. Why is it so high? Where is that emanating from? So just a couple of questions there.
Okay. On the cash balance, let me talk about the cash balance first. See, the cash, we cannot, we have to look at the cash balance along with other items of current asset and current liabilities. Just like there are, as you mentioned, we have got advance from customers. We have also given advance to vendors. It's not that we held on to the money. Okay, so they tend to get, largely offset. Just like our debtors, we have our debtors and creditors, and as of now, as of 31st March, our debtors are actually higher than creditors. So cash balance is more like, if you take all these 5 elements of working capital, cash balance actually becomes a sort of balancing figure. So it's not that we have to pay vendors out of this cash balance. We will receive money, continue to receive monies from our debtors and from our customer advances, and we'll funnel this in the form of creditor payments as well as advances to vendors. That's on the cash balance side. Sorry, what was the second question?
On the interest cost, you have close to about 16, 17 crores a quarter, and your depreciation is quite high. Just wanted to understand where are these two elements coming from?
Okay. So as you know, we have about 454 crores of loans on the books. Our loan balances have remained more or less steady during the year. So if you take the opening balance as of 31st March 21, it was about 450 crores. End of the year it is 454, so it's more or less steady right through the year. There is the interest on those funds. Most of it is in the form of short-term funds, which is working capital, demand loans, and bank overdrafts. Some of that is in the form of, about 72 crores of that is in the form of ECLGS loans, which are longer-term loans, which are given through a special government scheme, through the banks, of course. So overall, you will not see too much of changes at overall level. There's not much of change in the interest cost, fairly flat. As far as depreciation is concerned, while the travel services tend to have an asset-light model, we also have Sterling. That's one, which is more asset-heavy, does have properties. The other thing that's there in the depreciation, of course, the lease rental and the lease rental of various properties, which is offices in case of Thomas Cook Travel, Thomas Cook, as well as the resorts. Some of the resorts that Sterling has are on lease rental. So as per the accounting classification, some of the lease rentals get classified into depreciation, some amount of gets classified into interest. So it's coming out of that.
Okay. Thank you.
Thank you. The next question comes from the line of Pooja with TCG Advisory Services Private Limited. Please go ahead.
Hello, sir. Thank you for the opportunity. I have a couple of questions with respect to Sterling Resort. Can I get a breakup of how much percentage of customers would be timeshare and how much would be walk-in, the percentage of revenue that comes from timeshare? And also, I have observed that in Sterling Resort, the EBIT margin has declined from 38.4% to 27% and now 25.9%. So, what are we planning to keep this 25.9% steady going ahead?
Okay, two things. While we have around, as Vikram mentioned earlier, we have around 36 resorts with 2,300 rooms. The share of rooms, which is members and guests, the ratio is going up towards the guest side. So it's roughly around 55-45 non-members. Yeah. Non-members. So members and non-members. Members typically occupy around 45% of the rooms we have, or of the occupancies we have, and 50% of the occupancies are from the guest side. When guests check in, we get the room revenue as well as the F&B revenue as incurred at the resort. For the membership, we get the annuity revenues and the amortized revenues from the customers who are paid as a full product value. From the overall reported revenue for the year concerned, if you ask me what is the split of the membership amortized revenue is coming to the P&L, it is typically 1/3 of the overall revenue which comes as far as the reported number is concerned. That's where the revenue number stands. As far as profitability is concerned, why you see a decrease over the last quarter or previous years? Because last quarter or previous year we had some one-time reversals, which is giving an upside on the revenue as well as on the EBITDA side. That's the approach.
So are we planning to keep these margins steady? Like there will be no downside going ahead?
Come again? Sorry?
So are we expecting to keep these margins steady for Sterling, or is there could be some more margin decline going ahead?
No. No, in fact, the margins from here, this is Vikram here, are only bound to go up. The reason being, if you see that the non-member side of the business is actually growing at a faster pace, and typically it is moving from what it is currently at about 24-25% towards at least a 30% plus. It's actually moving there, and it is highly sustainable, and in fact there is opportunity in which it's growing because of the fact that we are growing the non-member vertical far more significantly as it was before. In 2019, for example, the balance of that mix was just the opposite. And now, actually, with the ramp up of the non-member business, and as I mentioned, we use distribution. It's a low-cost distribution method to ramp up our non-member business. That is what will yield us the incremental EBITDA going forward, which will then be on a sustained basis as we keep stabilizing.
Okay. Thank you, sir.
Thank you. The next question comes from the line of Sandeep Varghese, an individual investor. Please go ahead.
Hi, good afternoon. Thank you for the time. Can you hear me?
Yes, we can hear you.
Okay. So I think this is more a strategic question in general. I know that the group is entirely focused towards recovering all parts of the business, and that's clearly evident by what we see happening. When I say this is a strategic question, I mean with regards to when you compare Thomas Cook and its subsidiaries, their business models versus one that is predominantly online, and you have online players doing the same thing or similar things, right? Given the major shift of a lot of businesses towards online offerings that accelerated by the pandemic also, right? Moving forward, how do you see Thomas Cook and its businesses playing out? Is there going to be a shift towards mostly digital, or do you feel that there is inherently a significant offering still by having a partly offline, partly online model?
So Sandeep, I'll take that question, and I'll get my colleague Vishal to join in if he has any more points to add. So Sandeep, to begin with, I think we've always stated this and we'll continue to state this, whether it was pandemic or pre-pandemic. We were always an omni-operator in this space. We had digital mediums to reach out to the customer to either market the products or for them to actually book the products, and that continues to be so. We also had offline stores and also a third-party distribution network, which were managed and controlled by us, which were also distribution points for the customers to buy our services. So that model continues to exist today and will exist in times to come. And I think that's also a reaffirmation of how many of the digital models, specifically in the startup space, who came about and then expanded. I mean, some case in point will be some of the startups like Lenskart, Nykaa, Sugar, and everyone else that started online, but they very quickly realized that there's an offline store that also requires them to keep the kind of brand visibility and the kind of customer penetration that need to. But I think in our case, we started the reverse model. We were a beacon model, and we've kind of moved online. So that mix of online, offline will continue to operate across all our lines of business. What has accelerated, and I think you kind of touched on that point during this period, is how you kind of make that journey even more seamless. Look, if it's a bit of a product that somebody needs to buy and it's a 500,000 rupee product, it's much easier to make that decision online and move on. But when you're talking about a holiday service that comes into a few lakh rupees, obviously the customer requires a bit of a high touch. And also, there are complexities, right? Applying for a visa and the kind of questions that one needs to go around it, it's not an easy task. So somebody needs to sit across the table, get these sorted out, collect a lot of paperwork around it to ensure that he gets it right the first time, because there is no opportunity for us to go back and submit and resubmit the visas post a cancellation or a denial. So clearly, I think from a business point of view, we believe that the online-offline mix will continue. We'll continue to keep investing in giving the power in the hands of the consumer to choose how he wants to talk to us. Today, he has a call center, he has a distribution point in the form of physical store, he has an online store, and probably any other model that we will think will evolve over a period of time is something that will be thrown open to the customer to interact with us. On that note, I would like to hand over to Vishal if he has to add anything more.
I think, Sandeep, your question was more about the strategic intent. I think the intent continues to be an omni-channel player, and we will continue to engage with the customers through multimodal distribution points, be it digital or physical for that matter. And I think that is where we are. We continue to track what percentage of a business comes from each of these channels, and we ensure that all these channels are coherent with each other and customer gets a seamless experience whenever he engages with us. I think that's where we are at this point in time. Mahesh has pretty much covered where we stand from a strategic intent perspective, and I think this model has been tested, and we believe in this model at this point in time.
Sure, thanks. My final question is with regards to, how, as an investor, how do I realize Thomas Cook prioritizing the various segments that we operate in today? So, given that each segment experiences a different margin of sorts, at your group end, do you sort of prioritize the business that you have segment-wise based on their margins, or are they always given equal importance?
So, Sandeep, I think, it's like trying to say choose between your kids, right? That's not the model we follow. Well, there is some method in the madness which is in terms of capital allocation. Yeah. And that goes more about saying which business has the propensity to deliver more cash or more profit on the table. That's where the allocation will be maximum. Obviously, the levers when we decide profitability or cash allocation will be the kind of margin color or the margin visibility we have on the business and its opportunity to grow faster than what the market will grow at. So some of those considerations go in, but clearly, as I said, foreign exchange has been the front runner for the group and at Thomas Cook India for specifically, and continues to be the cash generator. But again, the inventory being cash, it also consumes a lot of cash in that business. The other businesses like holidays and all have been generating profit, and we continue to do so in the future. Albeit we had this bit of a hiatus in the last 24 odd months. But from a road to recovery and the future, we feel very confident about it.
All right. Thanks for your time.
Thank you. Ladies and gentlemen, due to the time constraint, the question and answer session ends here. I would now like to hand over the conference to the management for closing remarks. Thank you.
Good afternoon. I'm Madhu and Menon here. First of all, thank you for all the questions that have been asked today, which I thought were particularly, address concerns on the other side. I just want to sort of end this by saying two things. One, the bounce back that we are witnessing, especially in two of our businesses, foreign exchange as well as corporate travel, both of which are very close to their pre-pandemic levels, driving higher margins, is one important point to take note. The other aspect is that as the world opens, leisure will open also in terms of international travel. While we keep reading all these stories in the newspapers about visa constraints, the reality is that Southeast Asia, as we talk, is opening almost entirely without any restrictions, be it a Bali, be it a Singapore, be it a Malaysia, be it a Vietnam, be it a Cambodia. And all these locations are going to have direct connections both from the likes of Indigo, Vistara, as well as airlines from those countries. So access will not be an issue. My expectation is that in this quarter you will see the travel businesses clearly driving growth to the recovery stage. As far as the destination management businesses are concerned, As Debashish mentioned, we've seen a full recovery at Desert Adventures. The others Asia will start reopening. India will reopen closer towards the end of this year. But I think what is important to recognize is that the driving forces behind our recovery is one, Sterling Holiday Resorts, which has clearly shown 6 quarters. If you look at Thomas Cook and SOTC having at a fully integrated level, having actually come back to break even, if not profitability, and DEI, which has fully recovered from that point of view. I just want to, the last point I want to make is that this is not just a recovery story. This is actually a transformation story. Also a transformation story, because if you look at the costs of 40% that both Mahesh and Debashish alluded to, the reality is we intend to retain these savings rather than disperse them off as growth comes back, because we've done a fair amount of automation over the last 3 years, and these have complemented, if not replaced, the people who are the costs that we have reduced. My expectation is that all the companies in the group have transformed themselves from a cost and efficiency point of view, including Sterling Holiday Resorts. I mean, that is the most glaring example of a transformation. If you look within the Thomas Cook SOTC segment, the example of transformation is corporate travel, which in SOTC had not made money earlier but has become profitable with a 60% recovery. So, if you look at all these circumstances, we have very good reason to be optimistic of what we see. This is actually coming a little faster than we anticipated, because once the opening started, it's sort of blown open. And the demand that we are seeing, despite the higher input costs, is something that we wonder how it continues. But the world calls it recovery, or it calls it revenge travel. Whatever you call it, I think the higher input costs are actually beneficial to us, because we're seeing higher margins in the form of commissions that we get through the bundling of products. So, and if you look at Sterling, look at their average room rates. KK, correct me if I'm wrong, we're talking about a 26% growth in your room rates. Your cash generation, their cash generation has gone back to normal. So overall, I think we have good reason to be optimistic. And if we keep to the way we are right now, with minimal capex, sustained margins, and maintaining our costs, I believe that we will come through this a lot better than we were pre-COVID. Thank you.
Thank you. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.